folks, Dan Frio here, the rate update. I hope you had a great Thanksgiving. I did. I just got back last night, and today is the last day of November. Hard to believe December is tomorrow. So what happened with mortgage rates today? You might be pleasantly surprised. You're not so surprised, or you're not so happy when it comes to the stock market. So don't go away. I'll be right back. Well, I hope you had a great Thanksgiving, and now we're back, and it's hard to believe tomorrow's going to be December 1st. So if you're in the stock market, didn't like today, and I'm going to show you some indicators that if you would have paid attention to these things, and I apologize, I was gone last week, should have left you or brought you aware of these things. The Citibank Greed Index is kind of off the charts, so it's expecting a big pullback in the stock market. That could be very good for bonds, mortgage rates, and I'm going to go over that in a second. So let's get to it. Where were we today? So the headline news here is, this is an indicator that I watch on a daily basis, and very rarely do you see anybody watching this. You probably see stock pickers or day traders watching this, as well as other stock analysts, but I bet your mortgage person doesn't have a clue what I'm even talking about when it comes to this. So why do we pay attention to this number here, or the greed index? Well, great question. So let me explain it this way, and I'm not trying to beat a dead horse here for those that watch on a daily basis, but when you're in the investment world, I'm going to break it down into two components. There's all kind of different things in regards to commodity trading and options and this. Most people, they're going to do one of two things. They're either buying stocks, or they're buying bonds, or a combination of the two, or something like that. You might say, Dan, I bought a mutual fund. Well, yeah, that's stocks and bonds. And it could be a combination of some other things. But in its most simplest forms, when people invest, they're investing in stocks, bonds, or a combination of the two. Okay, so let's look at it in that pattern. If you have a stock market that's going robust and it's going up and up and up, and the economy's booming and everything like that, and you have $100 to spend, you're most likely, and you're young, you're going to put all $100 in the stock market and watch it run. Okay. However, as you get older, even when the stock market's running, you want more security. So you'll move down from 100%, putting all $100 in, to some bonds. Okay, so let's say it's a 75-25 split, and you're at my age, I'm 55. So now, let's say the stock market seems overpriced, we're in a pandemic, there's concerns all over the world, our election is in turmoils, all this stuff, and everything is just like, what's going to go on? Now you have that uncertainty. Okay, so now what do? Well, you take that concentration and you move it, and you put more money into bonds. Okay. What a bond is basically a secured investment. It gives you a higher percentage return than a savings account or a checking account. But it's a form of investment that has more stability behind it. I'll put it that way. But it has a lower rate of return. And so usually as you get older, the economy's doing really bad, or you don't want to take the risk of the stock market, you'll buy bonds. Okay, so think of that right now while we're going through this. Right now, this is saying the stock market is way overpriced. So what are people going to do? Well, they're probably going to start to sell because of everything is just too expensive and overpriced. And if you follow stocks, there's PE ratios and all kind of other indicators there that you or your financial advisor might say, probably a good time to get out of this thing. So let's see what happened to the market today. Well, down 271 as of this last tick, but I'm going to go over more details here. So now let's go to why people follow my channel. They follow my channel because of this number right here. What is this number right here? It is actually the bond that trades on Wall Street that determines, or it's the biggest determining factor of what's going on with mortgage rates. Okay? So this number here represents the price of the bond. In its simplest forms, I always say, as the price goes up, you pay more for a bond, you get a lower rate of return or yield. So if I pay more for a bond, my rate of return or my interest rate on my investment is lower. Well, if it's lower, and you have a lower mortgage rate. So we like when the price of the mortgage-backed security bond goes up. When the price goes down, we're paying less for that bond. That means the rate of return is higher. So we love when this number is green or going up. This is a pretty big move for today. It wasn't really anticipated this big of a move, and I'm going to show you other indicators down here on why I'm saying that. But what's helping is this greed indicator right here is kind of freaking out a lot of people. They're saying the market's way overpriced. Plus, normally in December, you're going to have a sell-off because people are selling stocks, taking profits, taking losses. They're doing a year-end reconciliation. I even posted a video earlier today to say, you're doing all this financial planning, but probably the biggest asset you have and the biggest liability you have is your home. Why are you neglecting that or possibly neglecting that? At least look at it, the details behind your mortgage and so forth. Okay, so here's what's going on here. Now let's get to the technicals. What we follow here is, here's what's happening to the price of the bond, mortgage-backed security bond, over the last quarter. Again, as this goes up, that's great. Rates are coming down. All right, our rates have eased just a hair. However, rates are still, even if we locked you back in here, rates are still lower here than they were here. And basically because a lot of the lenders aren't reducing their rates as they would in a normal market, because we're getting the flu season, coronavirus 2, more forbearances. There's a whole bunch of other things in the background, technicals in the background, that are causing a lot of lenders not to pass on that savings to the homeowners. Okay, so just to make it make sense there. So here's what's happening with the mortgage-backed security prices. All right, there's other lines that we have that are here, these red lines, and down through here, and you'll see all these lines going across here. These are Fibonacci levels. These are short-term and long-term ceilings and floors. Well, we created a new ceiling today because we passed through our old ceiling that was staying pretty consistent. Look at this old ceiling right here, the line below. We basically hit it there and stopped. We 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 broke through that today. Okay, we're not expecting a big rally, this rally to continue, I guess is the best way I'll put it. But in today's world, I don't know what tomorrow's going to bring. I just hate to say it that way. If we have a vaccine that comes out that's 100% proof and it's getting shipped, you're going to see numbers turn. It's probably going to, the stock market, you're going to see take off. But once the vaccine gets into the world and everybody starts getting back to normal, you're going to see, I predict, in the spring, a very rapid recovery. And we're going to see a V-shaped recovery, and you're going to see mortgage rates come February, March, April starting to move up. And throughout the year, it's going to continually move up, probably at least 1% higher than where we are today. All right. So because where we should be right now is the Federal Reserve has stepped in and basically stabilized the market. So what happens is this mortgage bond trades every day, and people go in and buy and sell and buy and sell for an equilibrium, just like a stock. What the Fed's been doing, they've been jumping in and buying where needed and the amount of quantity that's needed to stabilize the market, make it very stable. Okay, you have that here. But when there's excess buying because the stock market's crashing, you're going to have this short-term rally. So I'm expecting it to come back down into this range in here, and we should be in a normal market. We should be right here. The reason being is, if you look over the last quarter, that's where we are, right there. Look at it. And how you can tell that is, let me do something even more further. We have a 100-day, 50-day, and 25-day moving average. What have these numbers been doing over that time frame? You can see the 100-day moving average is right here, and it's right in this range here. Sorry, I got lines everywhere. But you have the 50-day and the 25-day moving average right here almost crisscrossing. And many times they have, right here, 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 here. Right there, there's a little bit of a spread. We should be trading right between those if it's a normal market. But again, it's not normal markets. But my short term for today, I'm really contemplating locking a lot of people. So if I see a little pullback tomorrow, I'm going to probably jump in and lock a lot of people tomorrow. But I follow this trend. Why am I going to lock you in if mortgage rates are continuing to get a little bit better? Conversely, if we locked you in a week or 2 or 3 ago, it is still better than where we are right now because, again, a lot of banks aren't what we call repricing. All right, I'm not going to beat that dead horse. So what I'm saying is I expect rates to come back or increase a little bit in the next couple days, but until I see a reversal, I'm not going to lock anybody in. All right, so that's that. Wrap up. Stock market ended 271 down. The Citibank euphoria or the greed index is basically pulling off the charts and saying everything is extremely bullish. What we're usually going to see is a pullback in stocks. Some good news is, and I posted again a video this morning, house appreciations on average throughout the whole country is up 7%. Some states such as Illinois is up 2, other states are 10 plus. You might want to look into refinancing because I'll show you another indicator or chart here. Rates back in February and further back. So February of 2020, January 2020, December 2019 and back, rates were approximately 1% higher across the board than where we are today. That coupled with at least a 7% appreciation, most likely on your home. Plus, you paying more down on your mortgage, so driving down the mortgage balance. You might prompt or you might want to look into, can I get rid of my PMI? That's a great idea. That could probably save you $150 a month. While you're doing that, can we get you a lower rate, maybe save you another $150 a month? You add those two together, $300 a month in savings. Wonder if you're saying, well, Dan, my payment's comfortable with me. Well, then let's look at taking your 28-year term remaining and doing a 20-year. Cut off 8 years and have the same payment. There's a slew of options that you have. So now the economic calendar. Today, pending home sales, it was disappointing. Why? Lack of inventory, not lack of people looking to buy. There's just no houses out there. So if you have a house that you're like, should I sell it? Sell it. Move on. The rest of the week, we have construction spending, manufacturing, payroll, continuous jobless claims, hourly work. Normally in a normal market, payroll number right here, jobless claims through here, and more payroll information here would really shake the market one way or another if it came in good or bad. This isn't a normal world, a normal economy. This probably isn't going to even have anybody blinking an eyebrow, okay? Now let's get on to a chart that I do every day. And I pulled this up, and I'm going to show you what I was meaning in a second on where rates were in February and further back in time. Right here is an index of where the 30-year conforming loan is, 30-year jumbo, 30-year FHA, and 30-year VA rates are on average throughout the country, okay? On average, the 30-year conforming is 2.79, jumbo is 2.91, FHA is 2.78, VA is 2.36. Now there's a whole slew of variations in this, and I'm going to go over those with you here in a minute when I go over my rates. But what this is telling us right here, though, is a one-day delta. A delta is a change. So a 7-day change, a 1-day change, a change since February 18th, 2020. Okay? So a 1-day change is we're down 2 basis points or 2/100ths of a percentage. Meaning if the current rate today is 2.79 and it's down 2 from where we were a day ago, that means that this was 2.81. Makes sense? 2.79 and then 2 plus the 2 basis points is 2.81. So if we were at 2.81 and they drop 0.2 or 2/100ths, we'd be at 279. I just want you to get this section over here are hundredths, which is the second decimal spot over on this rate. So You might be, oh, it's 2 basis points lower. Guys, it's 0.02 of a percentage. So it's really not affecting much at all. But look over here, 88 basis points. That's 0.88 to your percent. This is 110 basis points, meaning the rates were 1.1% lower now than where it was February 18th of 2020 on FHA and VA. And both these are down on average, say 80 basis points, so 0.8%. Okay, so that's that. I'll be posting this newsletter here in about 15-20 minutes, just saying rates are holding steady over the long holiday weekend. Hope you had a great long holiday weekend. So now let's get on to my rates. I changed things up a little bit on you. Hopefully I cleaned it up and make it a little bit easier to at least read. Here, let me check this right here. Okay, so let's go over my rates. And I used to do it was probably 15-20 minutes in regards to breaking down rates because I went through various credit scores and loan to values and a whole bunch of other things. But it was getting too time consuming, and I was losing a lot of people watching, and it was getting confusing. So let me go over this just briefly to explain a few things. Okay, so when I was going through the chart earlier, the daily numbers, and if you look at it right here, you can see where the current rates are. 30-year conforming, 30-year jumbo, FHA, VA, 279, and accordingly. Okay, I break it down in a little more detail. Okay, so I have a conventional loan. You have conventional, government-sponsored, and then non-QM or non-conventional, which are jumbos and other boutique programs. But right here, we're going to go over what the conventional rates are. If you're looking to purchase a home or do what we call a rate and term basically means you're taking your current balance, and that's all we're financing. Basically your current balance. You're not looking to pull out any money, all right? On a 30-year term, that's what these are, conventional 30-year terms. Purchase rate and terms up here. With a 740 credit score at 80% what we call loan to value, your rate would be 2.625. Okay, let me explain these couple of factors for you. First of all, how I break this down is these numbers are based on a $250,000 loan, single family residency, your primary occupant property, meaning you live there. All right. So the credit score is basically we pull TransUnion, Equifax, and Experian. We pull your mortgage score out of those, and that we take the middle score. So that's the score being used here. Every lender does it that way. 80% LTV, loan to value, means loan to value, meaning your loan amount divided by your value. So let's make it simple. If you have a $100,000 loan, $200,000 value, 100 divided by 200 is 50%. So this number is based on 740 credit score, 80% loan to value, purchase or rate and term refinance. Okay, the rate's 2.625 with an APR of 2.752. All right. If you're looking to cash out, 740 credit score at 75 loan to value, be the same rate. However, you can go to 80% here on the cash out. Rate's a little bit higher. Let's go back up here. If your credit score was 700 with the same criteria, credit score of 700 instead of 740, your rate would be higher. If it was 660, rate would be even higher. Why? Well, they're called loan level price adjustments. So what we use is the yield off of the mortgage-backed security, and then we add or subtract what we call loan level price adjustments to that factor, okay? And factors that can affect your rate or do affect your rate is what is your credit score? The lower the credit score, the higher your rate. What's your loan to value? The higher the loan to value, the higher the rate. Why? It's because it's riskier for the lender, so they add a higher yield or a higher rate to that mortgage. Okay, so that's basically how this works. So if I were to lay out a rate sheet on here, I would have 100 different variables because we can go 740 credit score, or a 720 and a 70 loan to value, or a 680 with a 55 loan to value. If it's a 4-unit property, a condo, or whatever. I mean, there's, I won't say endless variations of this, but there are a lot of variations. So when you call up somebody and they say, you say, what's a 30-year fixed rate? And they say, 2.5. It's their, I'll say it's their guess, I guess, or no, it's the answer that they're wanting to give you that they know that you want to hear, so you can give them the application. I'll never do that. What I do is I say, okay, well, let me just answer a few questions for me so I can give you a specific rate. What's your loan amount? What's your house value? What's your credit score? What are you looking to do? Rate and term, cash out. And I keep asking question after question because I want to give you the right answer, not the answer that you're hoping to hear and then to find out 2 weeks down the road. It's not that rate. Okay, so that's that. The next thing is the 15-year term. Like I said, the longer the term, the riskier it is for the lender, the higher the rate. So the shorter the term, with the same criteria, the lower the rate. Look, 2.25 here, 2.625 here. 30-year versus 15-year. We even have lower rates for 10 years. Okay? And then we have cash out. That's there, and the rate is 2.5. So now let's get to the government programs. Okay, government programs are FHA, VA, and USDA. I'm going to explain to you why you would fit into one of these categories. Let's start at the bottom up. If you're a rural property, there's even rural properties in California. We have a couple right now that we're working on that are about $600,000-$700,000 loans that fit actually under the USDA program. You can go 100% financing, purchase or rate and term. Our rate today is 2.375 on a 30-year fixed. Okay, but the property and your income has to fit specific USDA requirements. And I would love to be able to pull that information from you. Just email me your details and I'll get back with you saying if that house qualifies and your income qualifies. Would love to put you into that program. I'll give you all my information at the end of the video. VA, obviously you have to be a veteran with an honorable discharge, or you have to be specifically, have a DD-214 or certificate of eligibility, things like that. If you're a veteran and you want to look into this, we would love to help you. But with a VA loan, you can do a purchase or refinance up to 100% loan to value, 740 credit score. Our rate today on that is 2.375. Now, if you're neither one of these, many times we put people into FHA loans. The Federal Housing Authority has programs for people normally in this category. Will have it if you're putting down a small down payment, or your credit score isn't over 700, because that's most of the time where we would put you into an FHA loan. But you can, in an FHA loan, you only need 3.5% of a down payment. We'll finance 96.5% of the loan. And on a 740 credit score, your rate would be 2.375 with an APR 2.93. So those are my government programs. Now let's get into some specific areas that we're known for. And I'm going to have hopefully give you guys a little bit of a treat here today as well. We have some specials going on with the jumbo and super jumbos, and we have one boutique program that you might love if you're in these counties. So our jumbo program, I just ran a couple different ones. Up to $3 million is our jumbo. Up to $5 million is our super jumbo. If you're doing a purchase or rate and term, you go to 60% loan to value. We can go a little bit higher than this. And in many cases, we go to about 70 or 75% on the jumbo and super jumbos. 780 credit score, the rate would be 2.875, 30-year fixed, not a teaser, no points, not an ARM, not a whatever, a balloon loan. It's a 30-year fixed rate. Our super jumbo will go up to $5 million, same rate as of today. Okay? Now here's a really cool program we have. This is our Gigundo Jumbo. I won't say it that way, but it's a jumbo program that we have up to $1 million. If you're in any of these counties right here in California, you can qualify up to 95% loan to value. So you can buy $1 million home with 5% down. Normally, you're going to need 20% down. So think of the savings there. We have that program up to 95% refinance or purchase up to $1 million, 740 credit score, rates 3.5. Again, 95% loan to value. Like, Dan, that 3.5, that's a higher rate than jumbo. I can get a jumbo rate better somewhere else. I can too, right here. But your loan to value is probably going to be about 70. This could go to 95%. That is crazy. So those are my rates for today. So I hope you like what you see. I do this on a daily basis. I'd love to have you follow me. So please give me a thumbs up. Help the YouTube algorithms get my information out there to help even more and more and more people. Subscribe down below. Hit the bell so every time I do post a video, you get an alert and you can, I try hard to title the videos something that's relevant so you can read it and say, that's something I want to watch, or nah, it's nothing I want to watch. So that's what I ask. If you like what you see and you're like, Dan, I need you guys' help. Here's what I ask people to do every day. If you're in the process of building a home, refinancing a home, buying a home, and you already got a quote, send me the quote. Get a second opinion. That's it. Second opinion. No hard sales. I'm going to review it, go over it with a red pen, and I'll say, here's what they're doing, here's what I'm doing. If I can't beat them in the rate and the fees and everything else, I'll be the first one to say, God bless you, take it, sign, close, don't look back. Most of the time, almost every time, I beat them on the competition on rate or fees. Now, let me explain that in a little more details. I'm not going to come back to you with a lower rate and higher fees, nor am I going to come back with a lower fees and a higher rate. The goal is I want to win your business, I got to win it outright on both these. Why would you wouldn't want to come to me and pay a higher rate and lower fees or whatever. So I look to do is get you the same rate and lower fees, a lower rate, same fees, or lower rate and lower fees. And if I can't do that, I'll be the first one to say, God bless you. Just stay where you are and close it. Have a great holiday season and move on. But if I can win on both those, you might save $2,000, $3,000, $4,000 now. You might even think, oh, well, that's only $2,000, $3,000. Over the life of the loan, you can save tens of thousands of dollars. So what I ask you to do is email me a copy of your, what they call the loan estimate or your fee sheet. I'll get back with you within probably an hour or two and say, here's what I can do. Or, God bless you, take with what they're giving you. So how do you get a hold of us? Great question. So go to therateupdate.com. Scroll down here. This is an 800 number, 844-775-5626. That actually breaks out to loan. So it's 844-775-LOAN. Or you can go right here and you can click the Apply Now button. You can click Get a free quote, home purchase qualifier, or refinance rate checker. All these will basically put you through a questionnaire session or an online application. It'll take you a couple minutes max. That information will get sent to me securely, and I'll get back with you within a couple hours if it's during business hours. If it's after hours, I'll get back with you first thing in the morning and answer any questions you have, or at least review your application and get back with you and say, okay, here's exactly what I can or can't do. What a lot of people do is they email me that fee sheet or the loan estimate or whatever I was talking about earlier. If you're in the process right now, email me your information. Even if you haven't started anything, you're like, Dan, here's my mortgage statement. What can you do? Okay, email it to me. My email is D for Dan, Frio, so dfrio at preferredrate.com. So that is it. I can't make it any easier than that. So that's it for today. God bless. Take care. See you tomorrow, same time, same place. Bye-bye.